What would a debt default look like for the United States? I'm going to show you 3 scenarios of what could possibly happen here. I'm going to give you the charts that you need to see. I'm going to give you all the information and then of course connect the dots. My name is David Quintieri and I have been digging into this information knee deep in the trenches, bringing all the most complicated subjects to you, making it real easy. So in this video, we're going to look at the most important thing right now today. And while it seems likely that they're going to pass this, they're going to make it happen, more money will be spent, it's just a matter of when. When is the important word there? Hang on, because I'm going to show you how even a slight problem could be something much bigger. Let's go with this first. The debt ceiling standoff could start a recession, but default would be worse. Economists assess the damage that could occur in 3 scenarios, ranging from a last-minute deal to a lengthy impasse. So first things first, we got to understand the context. We're looking at a potential debt ceiling crisis in the US, and it's a bit of a ticking time bomb. My favorite, Janet Yellen, has warned that the government could run out of money as early as June 1st, and then later on she said by the 15th, it's unlikely they'd be able to pay their bills. So June 1st is kind of that day, but June 15th before that for sure, okay? So they don't exactly know when, it depends on how much money they're bringing in and so on, okay? Now, they're looking at this battle that's been going back and forth between the two sides. Oh no, we want to agree with this. No, we don't agree with that. And of course, every single time they do this, there's always nonsense that happens. They're trying to push through certain things and make it seem like they're really doing something for their constituents when ultimately they're just taking away from that, because the threat of all this only makes matters worse for people, knowing that in the end, they're just going to spend more money. We got to cover these 3 scenarios, okay? First things first, scenario 1. We get an 11th hour agreement that avoids default, but still unsettles the markets. The scenario wouldn't be a complete disaster, but it could still hurt. You see, even narrowly avoiding default could increase borrowing costs and hurt investment, cutting GDP growth by 0.3%, employment by about 200,000 jobs. A similar situation happened in 2011 and 2013. Remember the whole taper tantrum? Remember the downgrading of the United States? These type of events that, you know, in the grand scheme of things, you look back at it, that was nothing. But there were disruptions there, okay? That led to a downturn in the economy somewhat, and, you know, it's something that shouldn't really be taken lightly. Scenario 2, the standoff continues until the last minute, rattling the markets even further. If the drama extends within a day or 2 of the June 1st deadline, stocks could fall significantly over this period. You know, how much could they fall? You know, not that much. I mean, Dow Jones down, 1,000 points each day at the very most. And then as soon as there's a deal, it would reverse in the opposite direction. In this scenario, we might see a repeat of 2011, the GDP being slashed by more than 2%, employment falling by a few 100,000 jobs, could push the economy further into a recession. I don't expect that to happen. That's like a worst case scenario if the deal gets done, because ultimately they believe things are going to get passed through. Scenario 3. Okay, now this is a little bit of give and take. If they do agree to a $2.4 trillion spending cuts, then this would be, you know, this part of the whole demands from the Republican side. It could lead to a severe recession. While it might resolve the immediate debt ceiling crisis, it will lead to a long-term economic damage. This is what they're saying anyway. The scenario is the most severe out of all of these, but you got to understand, like, this is coming from the economists and what they are saying. It's not all doom and gloom, of course, because according to Mark Zandi of Moody's, the US can avoid a downturn. You know, we got to just be aware of this. We got to analyze the information, and that's why I wanted to bring you some charts, okay? So if you're ready for that, let me show you what we've got right here, right now. First things first, where they're spending a lot of money, that is Social Security, and you can see the Social Security Trust Fund, which the expectation here is that, you know, by this 2030 range in there, around those few years, that it would be completely out of cash. They're going to have to either slash or increase taxation. You tell me what you're feeling like having, okay? Federal interest rate payments as a percentage of the GDP, still like a low number. It would be, let's say 3.6% or so. Highest it's been, by the way, since the year 2000. It just shows us that as a percentage of the GDP, so like considering the size of the economy, this is something that we are paying more for. What with this, with that, everything, interest rates, and of course the activities of the central banks being front and center. So remember that, okay? Check this out. Federal debt held by the public as a percentage of the GDP that has continued to go up higher and higher and higher. And of course, this is something that they're just not going to be able to pay off tomorrow. Interest rates too high, borrowing costs in general, recession threats, everything that's been happening. And what are they planning on doing? Just adding on top of that. Federal interest payments as a percentage of the total federal receipts. So in terms of how much they're getting in, doesn't look good in this case either. They're just paying more and not getting enough in, despite the fact that they're getting more in. Isn't that strange? Okay. Federal debt held by the public in the trillions of dollars, and this is based on like the CBO projections over the years. It's going to be astronomical. So the amount of debt in total will increase, and we have higher interest rates. So the total borrowing costs increase. The payments are just out of line right now. They can't pay it back. And eventually, if it goes far enough, all of the tax dollars will go to simply pay for the debt. Like, isn't that wild? Isn't that crazy? So how are they ever going to resolve this? You're just going to lift the debt ceiling, allow more debt to come in, and then you can't even pay that debt back. Even if they do, which at some point they will have to, they're going to bring interest rates down. That doesn't resolve the problem because you've piled up the debt. And who in the end pays for that? Well, of course, the taxpayer. But there's a ceiling on how much tax they can force people to pay. Oh, that's right. The lender of last resort, the Federal Reserve. And when they do that, when they monetize the debt, which they're doing so right now, but indirectly. So they basically use JP Morgan and others, their best friends. They use them as an intermediary. So they can, send it through JP Morgan, then buy it back. Oh, that's not monetizing the debt, even though it can happen within 24 hours. But anyway, you call it what you want. So imagine that, where they go in and monetize that debt directly. That devalues your currency dramatically. And that is obviously what they want to do long term. Here we have it. The next part of this, I wanted to show you something about what's been going on. If the deal isn't done by June 1st, the global economy, at least according to most of the experts, will be facing a catastrophe of epic proportions as the US defaults on its debt. Obviously, that outcome is hardly going to make for a smooth ride, turmoil, and so on, okay? Yeah, I do agree. And I think you would too. Do you? If, big if, capital letters if, they don't actually resolve this. And they say, nope, both sides simply cross their arms and they say, la la la, I can't hear you. They don't come to a conclusion. And, half of these guys go on vacation or something, which they will do in summer. What is going to be the result of that? Well, I think it's pretty clear that there's going to be a catastrophe. I don't see that happening. I think they're going to resolve it. And my opinion is that this is going to happen at the last minute, or they're going to do a temporary extension. Okay, we'll give it 30 days. And then in that window somewhere, or even potentially multiple extensions, in that window, they come to the conclusion. I've said that 1,000 times before, but just want to make it clear that the market is saying one thing and people anticipate another. As negotiations over the debt limit continue to go on in Washington, The date at which the US government could be forced to stop paying some bills draws closer. Everyone involved has warned that such a default would be catastrophic. Okay, we see that it's going to, hurt the economy, recession is going to be an issue. You see all these. I'm just trying to show you that no matter where you turn, that's basically the message, okay? Lots of stuff, but I think it's important. Now, the stimulus is fading, growth is slowing. You're starting to see all of these mini fires. It makes what is already a difficult situation even more stressful. When the herd moves, it tends to move really fast and in a violent way. And this is true, okay? Very true. So the next part of this is covered in this video here, where I basically say, okay, you got this debt crisis, debt ceiling, all this crazy stuff happening. Well, that opens up an opportunity for some, a wild and crazy bet. 30-1 odds right here. You've got to check out this video. Click this link, 30-1 odds on this bet if you're interested. I broke that down. You can watch it right here. Click that. I'll see you there.